Hello and welcome. My name is Melissa Galasso, and I am super excited to talk to you about the first ASU of 2021. So FASB started the year off with a very narrow project, but one that actually is quite welcome. So it's a great way to kick off a new year. And so we're going to talk about ASU 2020-01, which really addresses reference rate reform. So we have been, talking about reference rate reform for some time, but honestly, I don't think it's gotten the attention that I would have expected for a global change. So if you had asked me back in January of 2020 what I thought would have dominated the conversation for accountants in 2020, I would not have said a global pandemic. I would not have said a virus that closes the economy. I would have mentioned reference rate reform, because we know that LIBOR is going away. And LIBOR is going away sometime in 2021. So you would have thought in 2020, it would have been a good idea, a good idea to talk about, well, how are we going to handle this? If I have a lease or an adjustable rate mortgage or a swap that's tied to LIBOR and LIBOR goes away, obviously that's going to have some impact on us. In addition, the volume of transactions, right? There are trillions of dollars of swaps out there that are tied to LIBOR. So between volume and then honestly, lack of time, right? LIBOR, as well as all related IBORs, interbank offering rates, are going away all at the same time. So we have a very narrow time period. We have a very large project, and it didn't get a lot of attention 2020. Obviously, global pandemics trump reference rate reform. However, the FASB didn't stop addressing this. Obviously, with the size of this, with all of the issues, we really needed to have some type of focus coming out of the standard setters. And so FASB and GASB have all issued practical expedients and exceptions to GAAP to address this reference rate reform. Now, reference rate reform is not new. In fact, it dates back to the 2012 scandal related to LIBOR. So LIBOR is the London Interbank Offer Rate. It's a rate the banks say they would charge another bank in interbank offering. However, that doesn't happen very frequently. So in reality, it is a hypothetical rate. And so there is someone at the bank who submits a rate, and there are about 20 banks that submit it, that create LIBOR. Well, what we found out in 2012 is that those rate setters were also colluding with the investment bankers from their bank to get the bank better outcomes. So after that scandal, we decided to move away from these rates and to rates that were a little bit more stable. So in the United States, we recommended SOFR, the Secured Overnight Financing Rate. That is what the Fed decided. There's a sterling equivalent for the UK. And so as a result, these are weighted average rates. So they're based on prior day trades. They're not hypothetical rates, so less subject to manipulation. And so FASB first issued a standard introducing SOFR as first a benchmark interest rate, because at the time we had very few benchmark interest rates. We had LIBOR, we had SIFMA, which was only added in 2017, right? And we had the US Treasury rates. And so as a result, not a lot of benchmark rates to be used for hedging purposes. So that was the first time that FASB really addressed the issue. Subsequent to that, they also issued in 2020, ASU 2020-04, a set of practical expedients and exceptions to GAAP. Given the volume, given the timing, they felt like it would be unfair to ask individuals to do GAAP because there is GAAP today. If you change the reference rate in a lease, it triggers remeasurement. It triggers reassessment of the underlying liability, and you have to go through all of these different considerations. And what we determined was triggering reassessment, triggering remeasurement, when ideally, like the person who entered into this, the organization really entered into it for the life of the item, and now LIBOR is just happening to go away. And so we had these exceptions to GAAP. However, it was very narrowly written, these exceptions, for when the reference rate was specifically impacted, right? So if it was related to LIBOR in particular and not just to reference rate reform overall. And so that raised some scope questions during 2020, right? Because now, as we said, this is not a US issue. It's not a nonprofit issue. It's not a government issue. It's not a public company issue. It's an all issue, right? This is a global reference rate reform. And so the derivatives market is obviously going to have to go through some transition as a result of this. And so for interest rate swaps, certain rates used to compute cash flows for variable legs are having to transition to alternative rates. Certain interest rate indexes used to discount those future cash flows of a derivative instrument to determine its fair value are transitioning to alternative rates. An entity is required to exchange margin payments on the basis of changes in the derivative instrument's fair value. Those payments are now being impacted by the interest rates used for discounting. And so all of this is sort of interrelated. The compensation or the interest amount earned on margin payments, referred to as contract price alignment, typically fluctuates with changes in interest rates index, and therefore is affected indirectly by reference rate reform. And stakeholders basically came back to FASB and said, right, your ASU 2020-04, super welcome. We appreciate all of these alternatives, right, and the exceptions to GAAP. The problem is the changes in interest rates are also impacting margining and discounting and contract price alignment, and not necessarily related to LIBOR. It could be other rates that are impacted as part of the whole market-wide transition away from LIBOR. And so as a result, the question was, well, if it's not directly impacted, but it's indirectly impacted, is it in the scope exception? And when we look at some of these questions, right, topic 848 is temporary guidance, right? It's a whole standard, topic 848, that is specifically for reference rate reform. And then when reference rate reform is over, that topic will be pulled from the codification. And so they were trying to figure out what we can apply it to as a result of this issue. And so discounting transition affects derivative instruments indexed to a wide variety of reference rates, including rates that are not necessarily going to be discontinued as a result of reference rate reform, but the transition is obviously impacting a lot of different entities, central counterparties, bilateral trades, and so everyone's saying, hey, it's a little bit bigger. And so the basic update here, which is, again, just trying to make this easier, given the fact that it's not voluntary, right? It's happening whether people want it to or not, whether you thought LIBOR was going to be around for the entire time of your mortgage or your lease or your hedge, right? Your swap. It's going away. And so as a result, they're trying to make this transition as easy as possible. So it clarifies the scope of 848 so that derivatives affected by discounting transition are also explicitly eligible for these optional practical expedients and exceptions in topic 848. So if you're electing this, you can apply to derivative instruments that use interest rates for margining, discounting, or contract price alignment that's modified as a result of reference rate reform. Right. So that could have been where the standard stopped, right? That could have been one of the, sort of final element of it, right? We're going to give you that scope inclusion. However, they didn't stop there. So they make some additional edits. And so one of the clarifications that they make is related to receive variable rate, pay variable rate cross-currency interest rate swaps. And they indicate that they may be considered eligible hedging instruments in a net investment hedge if both legs of the swap do not have same repricing intervals and dates as a result of reference rate reform. So again, giving us additional clarification because while they were in there looking at scope, there were other questions that were raised. And they also provide additional guidance on contract modification relief. And so again, they add some additional guidance about those that are impacted by discounting transition, how contract modification relief can apply to them. So this standard is really just, again, continuing the work on reference rate reform. While COVID continues to be a big topic, I think we'll start to see a little bit more focus on reference rate reform as LIBOR goes away. So what is the effective date for this standard? Well, you have two choices. You can do it either retrospectively or prospectively. So the ASU 2020-04 was issued on March 12th. So you can now apply this standard, ASU 2021-01, which sounds crazy to say, on a full retrospective basis as of any date beginning from that interim period that includes or is subsequent to March 12th of 2020. Or you can do it prospectively to new modifications from any date within the interim period that includes or is subsequent to the date of issuance, which again was January 2021, up to the date the financial statements are available to be issued. So again, when we think about this in terms of effective date, they're giving us two options. If you don't want to have to go back for it, you just want to go forward, that's okay. If you do elect to apply the changes for an eligible hedging relationship, any adjustments as a result of those elections has to be reflected as of the date you apply the election. And again, we talked about how ASU 2020-04 is a sunset provision. So the amendments do not apply to contract modifications made after December 31st, 2022, right? So there was a sunset provision that after 1 year after LIBOR goes away, they're going to pull this from the codification. And so if there's any contract modifications after December 31st of 2022, any new hedging relationships entered into after December 31st of 2022, and then any existing hedging relationships evaluated for effectiveness in periods after December 31st, 2022, except for those that were existing as of December 31st, 2022. Again, we're going to have that 2022 sort of sunset provision continue forward. All right, so we are off to a great start, our first ASU of 2021. I want to wish you all a very happy new year, and I hope to see you on a future Nano Learning. Have a great day, guys. Bye-bye.